I'm Michael Gray, Managing Partner of DFK Adelaide. Today I want to talk to you about structures. Every small business needs a structure to kick it off on the journey of business. So for today I'd just like to talk about three of those structures. That'd be the sole trader, the partnership and the company. And I just want to explain each of them, looking at their pros and cons between the cost of setting them up, the taxation implications, the risk association, and finally how they fit your vision. So if we start first with the sole trader, most certainly the simplest. It's very limited cost in setting it up, maybe a business name. It has taxation implications that are based really around the profit that the sole trader makes and your marginal tax rate as an individual. The third element is the risk. That is the worst part, if you like, of a sole trader, in that the risk can be borne by the individual assets. In other words, if things go wrong in the business and there's not enough assets in the business to cover your debts, then people can go through and to your personal assets. That is quite a large negative of being a sole trader. And the final element is how does it fit your vision? If you're happy to remain as a small business and not grow it, then maybe the sole trader is for you. But if you're looking to have 10 shops, if you're looking to produce an app for the world, if you have a bigger vision, then perhaps the sole trader is not right. So in summary, the sole trader is the cheapest, but it also has the highest risk associated with it. Let's move on now to the partnership. And a partnership, if we explain it in the same way, the cost associated with a partnership is minimal, very much like a sole trader, but a good advisor would suggest a partnership agreement as struck by a lawyer, covering such matters as to how you get paid and how you dissolve the partnership. The second element there, the taxation, the issue about a partnership is it has to lodge a tax return, but the actual partnership itself is not the one that gets taxed. So all profits flow straight down to the individual partners, and so therefore the tax rate, if you like, is relevant to their marginal tax position. The issue about risk, well, the risk is very much the same as a sole trader. If things go wrong in the business, it's possible to go outside of the business to your private assets. It is made somewhat more complex in that partners themselves become jointly and severally liable to those debts, so that you can have a scenario where a partner has no money, one other partner has the money, and all the debts are chased from that particular partner. That becomes more complex. The final element of the four is the vision. Is a partnership the right structure to take your vision out to those multiple shops or that app for the world? And it may not be, simply for the same reasons as the sole trader. So in summary, it is a slightly higher cost than a sole trader, but it still has the risk associated with a sole trader. So to the last structure, the company, the Pty Ltd. A company is certainly more expensive to set up and to run than a sole trader and a partnership, and that's simply because you are reporting to more than one government bureaucracy. It is required to be produced in a certain way, so there's more cost associated with it. The tax consequences are a fixed rate. It's a 30% on $1 of profit or $10,000 of profit. That actually is reduced somewhat now to 28.5% if you're below $2 million worth of turnover. The actual flexibility around that tax rate is nevertheless available because you can also call yourself an employee. The strange concept really, you can own a company but also be an employee of yourself. And that actually is therein lies the flexibility around striking the best tax rate for the circumstances. As far as the risk, now this is really where the company comes into its own, because historically companies were set up to enable a business to take risk, which is really what a business is all about, risk and reward. And it does that by simply putting a ring around the business and its assets and keeping your private assets outside of that. There's no doubt over the years that's been watered down by provisions for insolvent trading and directors' guarantees. But nevertheless, it is still a strong structure around risk. Finally, the vision. Well, if you're looking to go forward and grow your business spectacularly and keep it going for 50 to 100 years, then most certainly a company is the vehicle for you. So in summary, all about our structures. Sole trader, it's the cheapest, but it carries risk. The partnership, a little more expensive, but it still carries risk. And a company, it carries lower risk, but it's more expensive. But in terms of its vision, it is a good vehicle for carrying your vision.